gravy, and you thought earnings season was over. Shopify shares plunged 19% on weak guidance. Disney says streaming is nearly break even, but shares sink 10% on soft guidance. And damn it, Palantir crushed earnings. So why? Why is the stock down? Well, this is what we're going to discuss because we don't seem to be out of this incredible volatile market yet. And these earnings were truly jaw-dropping, yet the stocks couldn't get any momentum, which means we could still be in somewhat of a correctional phase for this massive run-up we've seen in some of these companies over the last year. And that is a conversation you need to appreciate on your path to financial independence to perhaps one day retire early. Damn it, go hit that like button and subscribe to join me on that journey as well. But let's start with Shopify, then we'll get into Disney, and then we'll talk about Palantir because Shopify, yes, got creamed 19%. And I've stated that Shopify, being a Canadian-oriented tech company, which there's only a handful next to Constellation Software, OpenText, these few companies get a lot of attention in the Canadian market, which led them to becoming a bubble, unlike their US counterparts. I mean, you look at some of the big tech companies in the US, and none of them went through a whopping 82% correction during the interest rate cycle that caused that massive correction. And the stock ran up an insane 200% in just a short couple years, not even 2 years. I mean, we're talking about 100% a year gains, right? And now that leads to these earnings that, though are awesome in this tougher market environment, sometimes people just don't care, right? So Shopify revenues were up 23% and up 29%, adjusting for the sale of their logistics business because they tried to compete with Amazon. They said that's too costly. Forget about it. People want to see earnings. They want to see bottom line. And that's what we got. They're claiming they're trying to build a 100-year company here in software. I don't know if you could see some AI companies that make websites come out that could potentially start, competing with Shopify. They'll have to pay close attention and, be able to compete with that. But let's just scroll down and take a look here. And then we'll get into some of the guidance because we can see they actually posted their outlook for 2024. Let's start with the outlook actually, because that's what's killing the stock apparently. And that basically all prior financial outlook statements made by Shopify continue on a forward-looking information, blah, 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 blah. But they're expecting revenue to grow in the high teen percentage rate. There's nothing wrong with that on a year-over-year basis. Gross margins for Q2 is expected to decrease approximately 50 basis points, so that's not too good. GAAP operating expenses dollar to be up at a low to mid-single digit percentage rate compared to Q1. So this is what's kind of killing the company. It looks like, they're going to have some expenditures that are coming into play here. But let's just look at the numbers themselves. This quarter was beautiful, man. I mean, you're talking about from 1.5 billion to 1.86, like a $300 million increase, probably thanks to Mr. Beast, baby. The Mr. Beast, they probably giving this guy so much money. I mean, when you look at sales and marketing, that increased to $361 million from 287. Mr. Beast probably getting like 100 mil of that. Let's be real. I wouldn't be surprised. Research and development costs continue to go down. This is great. Like I said, when you get a company that's reached maturity with their software, you don't want them to overexpend on research and development. So it's nice to see that kind of resolving a bit, leading to about 21 cents in earnings per share. Diluted shares out on the market have actually decreased. So it looks like they took some shares off the table a little bit there too, which is, all in all, this was a great earnings period. And I guess the market just does not want to see the company slowing down. If you take a look at macro trends on a revenue basis, they've been playing, the worst market environment they had about a 15% growth rate on a quarterly revenue reporting, whereas, now that we're back into the 20% digits, we're going to go to the high teens, which seems nominal for the company at this scale. Honestly, I don't think that's bad. This could present a buying opportunity if you believe there's some value in it. So let's hope Shopify comes down more. Again, you're buying a company for $109 billion, which seems excessive to me, considering they're generating only about $7 billion in revenue. The bottom line isn't that great right now. You're really buying this for those future profits, and presuming the company will keep growing at this scale 10 years from now. Might not be the worst buying opportunity, right, if that persists. But we got Walt Disney coming in here. This is a dividend favorite that ended up cutting the dividend. They have been through one of the most tumultuous periods in their entire history, and it's only getting more tumultuous because they've been drowning people in Star Wars and competing in streaming. And I told you guys, YouTube is the premier business for streaming and content because the costs that come into play, I mean, for them to only just be getting profitable now on streaming, again, I don't want to be a part of that. And I feel like, movies and entertainment is highly cyclical, which is why Disney invested so much into their theme parks, because they know the theme parks will always be a staple for the business. The stock has done absolutely nothing since 2015. You only just reintroduced the dividend, and the stock is now, again, not doing too much on its earnings here. It's kind of stuttering. I'm not a big fan of Disney, to be honest, but let's take a look at the revenues here, because we can see that their total revenues came in at $22 billion versus 21.8, which represents a 1% growth rate. Whoop-de-doo, nothing crazy there, right? Experiences are up 10%, so we can see the investments in their theme parks are paying off. People want to get out. Sports and entertainment up 2%. And then entertainment in general is actually just down. So not the best thing we want to see here. But if we dive a little bit deeper and we take a look at the streaming, we can see that Disney Plus here and basically, Disney Plus Core is up 6%, which is pretty great to see. And this is just in the millions, obviously, subscribers. So, they're crushing it from this end. You got Hulu in here as well. Hulu's doing pretty well. Nominally it's up 1% in growth. So nothing crazy, but we can see that they're getting about $8 for US and Canadians a month. Seems to be the average cost for Disney there, whereas Hulu's kind of expensive at $11.84. A little bit more premium, but I honestly I don't care for streaming. If you like streaming, you're playing in a very cyclical industry where people, it just ebb and flows, right? And I mean, Netflix, a lot of these companies are hardly profitable comparable to YouTube and ads. That's why Amazon's been introducing ads, right? They're trying to nurse every dollar they can out of this. So I don't know what you think. Do you like Disney? I wouldn't be buying it here. It's just one of these companies that's, I think, going to continue to have hardship into the future. We'll see if they can get out of their hole and start going back to a growth company, but I feel like they've kind of hit maturity and they're stagnating a lot. Even though you see this incredible revenue growth from macro trends, you have to imagine that a lot of this revenue is being sucked up by cost. It's kind of like Amazon. You generate these massive, insane revenues, but all that money and all that revenue is being generated because of other people on the platform that has to get paid out. And it's similar to Disney. They have to pay an arm and a leg to produce this content. And even the theme parks are hyper expensive, but are way more profitable than what they're currently doing with content creation. So you can see that in their net income, right? As their net income just has been abysmal for the last couple of years. So I don't know. We'll see if Disney can pull themselves out of the ground. What do you think? So let's talk about Palantir, because I know this is a favorite of many, and it did drop on earnings, which I can really only kind of conclude has to do with the fact that the stock ran so much in the last year. I mean, it's up 177% in the last year. Its valuation has kind of got a little nutty. I said the stock's better at around 15 to 20 bucks a share. Ideally closer to 10, but I don't think we'll go back there. I think 15 to 20. If you get under 20 bucks at this point, you're probably getting a favorable value for it. And just taking a look, because they've come back. I mean, their revenue growth is back up 21%, which is exactly what I was saying. They need to kind of get back to a growth phase because they've really tampered off from where they once were. But customer count grew 42% year over year and 11% quarter over quarter. So whatever they're doing, they're getting some great growth out of their customers. And this is what I said about software. It'd be nice to see what the turnover of their current clients look like, because when we take a look at revenue at 518 million, that's gross profit, but total revenues here of 634 million versus 525 million is insane. And gross profit is up like $100 million year over year, which you can't gawk at. It's nothing short of insane. This is great growth numbers. And we can see that they're also increasing sales and marketing similar to Shopify. What I don't like seeing is this $20 million increase on research and development. This company hasn't matured with its software, which I'm curious to what their core software looks like, why they have to spend so much on research and development. I told you this stock would absolutely explode if they just cut one of these costs by 20 or 30%, added it to the bottom line, and this stock would go to the frigging moon, because right now all their income is from interest income. They generated $43 million from interest income, which means the net income of $106 million, 40% of that purely is just coming from interest income. So I don't think the stock would be seeing such great performance if it wasn't for that, because that's what's hitting the bottom line. And the company still continues to dilute pretty significantly. I mean, about 10% dilution period from a year over year basis, which continues to hinder some of the growth in the company if you're a shareholder, right? So And I mean, the stock has done exceptionally well over the last year. We're nowhere near back to where we were. I think the company's got a little ways to go to dig themselves out of this hole that they're trying to pull themselves out of, but they're on the cusp of doing so. So it'll be neat to see what kind of comes into play with this as a software play. I would love to know what you guys think about Palantir, because I've had a love-hate relationship for it, but I think it's kind of getting to a place now where they're really proving themselves out. And if they can kind of keep this up moving forward, I mean, yeah, in 5 or 10 years, this could be a huge growth beast, right? But like I said, revenue's getting back in the 20%. We'll see if they can kind of continue that. That would be great to see, not seeing so much of an expansion in expenditures. If we take a look at that net income, like I said, the net income's deceptive because it's all mostly just coming from interest income. So at least we're out of the hole. I don't think they'll ever have a negative period of negative bottom line ever again. So yeah, very fascinating stuff in the midst of this earnings season, guys. We're going to be getting into the Canadian stocks here very shortly. We're going to be talking about Enbridge. We've got TELUS, I think, posting tomorrow. So I'm very excited to see what the Canadian counterparts look like tonight. Airbnb, Robinhood. We need to see if these stocks can hold up because they've also gone on some pretty historic runs. I mean, you take a look at the good old Robinhood stock, and I know they've been getting investigated and have some issues, but they're up 44% this year. Over the last year, up 100%. Let's see if they can hold. But I'll pass the question off to you. I'd love to know what you think in that comment section below.